In today's fast-paced financial landscape, choosing the right investment strategy can feel overwhelming. With countless options available, from stocks and bonds to real estate and mutual funds, it's crucial to navigate this terrain wisely. In this video, we will explore various investment strategies, helping you understand the pros and cons of each approach. Whether you're a seasoned investor or just starting out, our goal is to equip you with the knowledge needed to make informed decisions that align with your financial goals. We'll delve into key concepts such as risk tolerance, time horizon, and diversification, all of which play a vital role in shaping your investment journey. By the end of this video, you'll have a clearer understanding of how to tailor your investment strategy to suit your unique circumstances. You'll discover practical tips and real-world examples that can help you avoid common pitfalls and maximize your returns. So, if you're ready to take control of your financial future and make smarter investment choices, stay tuned as we guide you through the essential steps to finding the right investment strategy for you. Step 1. Assess your financial goals. The first step in crafting an effective investment strategy is to assess your financial goals. Begin by identifying both your short-term and long-term objectives. Short-term goals might include saving for a vacation or building an emergency fund, while long-term goals often revolve around significant milestones like retirement or purchasing a home. Clearly defining these goals will provide a roadmap for your investment decisions. Next, consider your risk tolerance. Understanding how much risk you are willing to take is crucial, as it directly impacts your investment choices. If you're comfortable with volatility, you might lean towards stocks or mutual funds. Conversely, if you prefer stability, bonds or savings accounts may be more suitable. Aligning your risk tolerance with your financial goals ensures that your investment strategy is both realistic and achievable. Finally, evaluate your current financial situation. Take a close look at your income, expenses, and savings. This assessment will help you determine how much you can allocate towards investments and identify any areas where you can cut back to boost your savings. By thoroughly understanding your financial landscape, you can make informed decisions that will set you on the path to achieving your financial aspirations. This foundational step is essential for building a successful investment strategy tailored to your needs. Step 2. Understand different investment types. Once you have assessed your financial goals, the next step is to understand the various investment types available to you. Researching options such as stocks, bonds, mutual funds, and real estate is essential for making informed decisions. Each investment type has its unique characteristics, benefits, and drawbacks, so gaining a comprehensive understanding is crucial. Stocks represent ownership in a company and can offer high potential returns, but they also come with increased volatility and risk. Bonds, on the other hand, are considered safer investments that provide fixed interest payments over time, making them suitable for those seeking stability. Mutual funds pool money from multiple investors to invest in a diversified portfolio, allowing for easier access to various asset classes without needing extensive knowledge. Real estate can be a tangible asset that generates rental income and appreciates over time, but it requires significant capital and ongoing management. As you explore these options, consider the potential risks and returns associated with each investment type. Think about how each aligns with your overall strategy and financial goals. By understanding the strengths and weaknesses of different investments, you can create a balanced portfolio that reflects your risk tolerance and aspirations, ultimately guiding you toward financial success. Step 3. Determine your investment timeline. Determining your investment timeline is a crucial step in shaping your investment strategy. Start by establishing how long you plan to invest before needing access to your funds. This timeline can vary significantly based on your financial goals, whether you're saving for a short-term objective like a vacation or a long-term goal such as retirement. Understanding that longer timelines can often accommodate higher-risk investments is essential. When you have several years or even decades before you need to access your funds, you can afford to take on more volatility in exchange for potentially higher returns. This is because you have time to ride out market fluctuations and recover from any downturns. Conversely, if your timeline is shorter, you may want to prioritize more stable investments that offer lower risk, such as bonds or money market accounts. Aligning your investment choices with your timeline is vital for optimal results. For instance, if you plan to buy a home in 5 years, a conservative approach may be best, while a 20-year timeline could allow for a more aggressive strategy focused on growth. By clearly defining your investment timeline, you can make informed decisions that align with your financial goals, ensuring that your investments work effectively for you over time. Step 4. Evaluate your investment knowledge. Evaluating your investment knowledge is a vital step in developing a successful investment strategy. Start by assessing your current understanding of investment principles and market trends. Reflect on what you know about different asset classes, risk management, and the factors that influence market movements. This self-assessment will help you identify areas where you feel confident and those where you may need further education. If you find gaps in your knowledge, consider seeking educational resources or professional advice. There are numerous books, online courses, and webinars available that can enhance your understanding of investing. Additionally, consulting with a financial advisor can provide personalized insights tailored to your specific goals and risk tolerance. Professional guidance can be invaluable, especially for beginners navigating the complexities of the investment landscape. Staying informed about market changes and investment strategies is equally important. Regularly follow financial news, subscribe to investment newsletters, and engage with reputable financial websites. This ongoing education will help you adapt your strategy as market conditions evolve and new opportunities arise. By continuously evaluating and expanding your investment knowledge, you empower yourself to make informed decisions that align with your financial objectives, ultimately leading to greater success in your investment journey. Step 5. Create a diversified portfolio. Creating a diversified portfolio is a crucial step in managing investment risk and enhancing potential returns. The key to diversification is spreading your investments across different asset classes, which helps minimize the impact of any single investment's poor performance on your overall portfolio. By including a variety of assets, you can achieve a more balanced approach to investing. Start by including a mix of stocks, bonds, and other investments based on your financial goals and risk tolerance. Stocks can provide growth potential, while bonds typically offer stability and income. Additionally, consider incorporating alternative investments such as real estate or commodities, which can further diversify your portfolio and reduce correlation with traditional assets. This blend allows you to capture growth while mitigating risk. It's also essential to regularly review and adjust your portfolio as needed. Market conditions, personal circumstances, and financial goals can change over time, making it necessary to reassess your asset allocation. Periodic evaluations will help you identify any imbalances and ensure that your investments remain aligned with your objectives. By maintaining a diversified portfolio and staying proactive in your investment management, you can enhance your chances of achieving long-term financial success while navigating the complexities of the market. Step 6. Monitor and adjust your strategy. Monitoring and adjusting your investment strategy is essential for long-term success. Regularly reviewing your investment performance allows you to assess whether your portfolio is meeting your financial goals. Take the time to analyze how each asset is performing and determine if any adjustments are necessary. This proactive approach helps you stay on track and make informed decisions based on current data. Staying updated on market trends and economic changes is equally important. The financial landscape is constantly evolving, influenced by factors such as interest rates, inflation, and geopolitical events. By keeping an eye on these trends, you can identify potential risks and opportunities that may impact your investment strategy. This knowledge empowers you to make timely adjustments that align with the changing market conditions. Flexibility is key in the investment world. As your financial goals evolve, whether due to life changes, new aspirations, or shifts in your risk tolerance, be willing to adapt your approach. This might involve reallocating assets, exploring new investment opportunities, or even reassessing your overall strategy. By remaining open to change and committed to continuous improvement, you can enhance your investment outcomes and ensure that your strategy remains relevant and effective in achieving your financial objectives. Conclusion: Key takeaways on investment strategies. In this video, we've explored the essential steps to developing a successful investment strategy. We began by emphasizing the importance of aligning your investment choices with your personal financial goals. Understanding your objectives, whether they are short-term or long-term, sets the foundation for making informed decisions that suit your unique circumstances. We also discussed the significance of diversifying your portfolio to minimize risk and enhance potential returns. By spreading your investments across various asset classes, you can create a balanced approach that adapts to market fluctuations. Additionally, we highlighted the need to regularly monitor and adjust your strategy based on performance and changing market conditions. Flexibility is key to navigating the ever-evolving financial landscape. As you embark on your investment journey, we encourage you to take action. If you found this information valuable, please subscribe to our channel, like this video, and share it with others who may benefit. Your engagement helps us create more content that empowers you to make informed financial decisions. Finally, don't forget to explore related content on our channel or website for further learning. The more knowledge you gain, the better equipped you'll be to achieve your financial aspirations. Thank you for watching and happy investing.